Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is John Champalia, CEO of Sprott Asset Management. And we are talking about investing in metals and miners today, which have become some of the hottest trades this year. Gold, silver, copper, uranium, all these metals have surged, though for somewhat different reasons, and their miners have done even better. And Sprott offers some excellent ETFs that focus on gold, silver, uranium, and copper miners. So John is the perfect guest to talk about this space. John, welcome back. Great to have you with us today.
Yeah, thanks for having me back.
So let's start with gold, which is the best performing asset class this year. And gold recently posted its worst one-day drop in years. And in fact, it is on track for weekly losses, but still up more than 57% year to date. So tell us what's going on with gold and where you see it heading in the coming months.
Yeah, I mean, it's been an unbelievable year for gold. And just to put it into context, this is the second best performing year for gold since it was basically, come off the gold standard in the early 1970s. Wow. The only year that is ahead of the current year is 1979. And that was a year, if you remember, we had very, very high inflation, very high interest rates, and gold was obviously reacting to that kind of environment. And, not too long before that, large equity drawdowns, a lot of geopolitical risks, oil crisis, all those kinds of things. So gold is having a similar kind of experience this year. Some parallels there. Obviously, it's about geopolitical tensions, the breakdown of the global trading system, which has been in place since 1945. Enormous debt levels, very high inflation, and I think government willingness to run hot inflation, both from a fiscal and monetary perspective. You put all of that together, and people are revaluing gold because gold traditionally acts as a low correlation asset class, and it also historically has acted as a safe haven asset. And what's interesting to us is that the two other traditional safe haven assets are US Treasuries and T-bills and the US dollar. And in this market environment, both of those have either been trading sideways or down in value, whereas gold is, as you mentioned, up over 50%. So gold has kind of taken charge here in terms of being the safe haven asset as people are starting to reallocate to gold. And I would say that for many institutions and individuals, it's the first time they've allocated to gold in probably more than a decade. So it's been a long time in the making. And we think it's just the start, irrespective of the incredible gains we've seen in the last 12 or so months, because we think it's really being driven by a large structural shift in the global financial system, which is referring to the fracture of relations between, East and West. And obviously China and the US are at the focal point there in terms of trade and central banks and the, reserve assets that they're holding. There's clearly a shift back to gold.
Now, silver is often called the poor man's gold, and it has managed to outshine gold this year. It's up almost 68%, despite a recent pullback this week. And you mentioned central bank buying, safe haven, etc., which applies to gold. But unlike gold, silver has significant industrial applications. So it is used in electronics, solar panels, and other technologies. So tell us about the key factors that drove silver prices to an all-time high. Recently, it surpassed the decades-old record, which was set during the infamous Hunt Brothers scandal of 1980.
Yeah, we're really relieved that silver has finally broken the most recent high that was in 2011. And it's been a long time in the making. And silver was really held back for a long time. It really frustrated a lot of our investors because it was undervalued. And I think the market is clearly re-rating silver. And there's a few things obviously driving that. One, it does have a correlation to gold, even though, as you correctly mentioned, it's a hybrid metal. It has monetary attributes to it. It also has industrial attributes to it. But gold is clearly pulling it along. And it's, as I said, it's psychologically, I think, very important that it's finally hit a new high. Similar to gold, it took gold a long time to break its old high that was around 1900. And once it broke that previous high, it just really accelerated from there. So we're hoping that silver catches a similar bid and moves higher. Obviously, what is helping silver is also related to some substitution, meaning when the price of gold gets to very lofty levels like it has, you see in some markets, and India is a really good example of this, where people can no longer afford to buy gold because they like to store their wealth in hard assets like gold and silver. And you've seen a lot of silver moving towards the Indian market as an investment. That's clearly helping. You also see a lot of silver being used for solar panels. And the reason is it's one of the most conductive metals on Earth. And China has essentially flooded the world with very cheap solar panels. And more of the silver supply is being used specifically for solar panels. So there's a demand driver there that's obviously relatively new, relative to, let's call them old industrial applications like photography. And there's a much smaller stockpile of silver above ground. Gold, there are hundreds of billions of dollars of gold sitting above ground in vaults, either by central banks or ETFs or high net worth investors. There isn't the same stockpile because a lot of silver gets used and it doesn't get recovered. And so it's a smaller market. And when it wants to move, it tends to move quite quickly. And it's nice to see it having a bit of a catch-up trade. We've definitely seen institutional interest in silver. The valuation between gold and silver is still quite wide, meaning, there's a gold silver ratio that the market likes to look at to determine, how expensive is gold vis-a-vis silver. We got to very extreme levels a few months ago. That is clearly starting to tighten. And we think silver definitely has more room to run, even though it's had a really good performance so far in 2025.
Now, let's talk about gold and silver miners, which are usually seen as leverage plays on the metal. So obviously, they have done even better this year. Your gold miners ETF SGDM is up more than 117%, and the junior gold miners ETF, which is SGDJ, that is up almost 120%. And you also offer gold and silver miners ETF, GBUG, easy to remember, and silver miners and physical silver ETF, SLVR. These have also done quite well this year. So tell us about the miners.
Sure, yeah, they've been really great performers, and they've actually outperformed things like technology stocks, which is really nice to see that every once in a while them getting the spotlight. And this is really welcome because last year gold was up around 25%, and the gold stocks were kind of muted, and everybody was kind of disappointed by that. And what's happening here is clearly a re-rating of the gold stocks and silver stocks on the back of very high metal prices. So if you think about gold companies that are producing right now, selling metal at spot prices, which are at $4,000, a lot of that price lift is falling to the bottom line. So you're seeing that operating leverage really produce strong margins and profitability. Hopefully that'll be returned in part to shareholders through dividends and share buybacks. And then you obviously have, optionality, meaning the value of deposits in the ground are becoming more valuable. So that's what's re-rated the value of these stocks. even though the stocks are up about 100%, like you mentioned, in aggregate, they still are not trading at crazy valuations at current metal prices. So some people might think, okay, well, that's a really big return. These stocks must be hugely overvalued. If you look at traditional market valuation metrics, we're about half the valuation of the last cycle. So even though we're seeing some volatility, obviously, in the stocks and the metal prices right now, they are not, as a group, trading at excessive valuations. And I think that's what's attracting not just specialist investors, but we're seeing more generalist investors starting to look at the segment again, which is interesting. They haven't been well positioned in the sector since the last cycle, which ended in 2011, 2013-ish. So we're starting to see renewed interest there. Just, it's hard to ignore these companies when they're printing money the way they are right now.
Let's talk about uranium now. And we have had you on this show, I think it was last year, when we talked about uranium, how it is benefiting from the AI data center build out. And that build out has just accelerated. All the hyperscalers, they are now spending hundreds of billions of dollars on building these data centers. So talk to us about the current demand and supply dynamics in the market, because your firm, you offer many uranium focused funds, including a physically backed uranium ETF that trades in Canada, and the uranium miners and junior uranium miners ETF that trade in the US. So tell us more about these areas.
Yeah, I mean, it's been a hugely successful investment for our clients. We got involved in uranium about 5 years ago when nobody cared about this technology. Most people were on the belief that it was going to be phased out. Most countries were marching along that path, and the price of uranium was, sitting in the $20, $28 per pound, I think, when we first stepped into the market. Now you have a market that's obviously re-rated, and uranium is trading at $80 a pound. But I think more importantly, for investors to know, is that the world has done a massive pivot back to this technology. In the United States, we've essentially built two new nuclear power reactors in the last 30 years. Those were Vogtle 3 and Vogtle 4 in Georgia. And before that, it was basically a drought. Nobody was building anything, and people were even prematurely closing nuclear power stations because the future didn't look bright. Power prices were low. There was very cheap natural gas that was giving nuclear a hard time. And now you fast forward to what's happening now, and you're seeing nuclear power stations in the United States that have been closed for 2 or even 5 years being turned back on. You're seeing power stations that were partially started, not completed. The plans are to finish building them and turning them back on. You're hearing about the likes of Google that are going to, have plans to build data centers around shuttered nuclear power stations because they want that base load power. And what that means is basically a form of electricity production that can run 365 days a year, 24 hours a day. It is the most reliable form of power. It also has no greenhouse gases. And the hyperscalers are so hungry for electricity. Just today, the Department of Energy said that they want to have expedited reviews for these hyperscalers and these data centers so that they can tap into these new forms of electricity much quicker. You also have the Department of Energy really becoming very active in terms of, reforming permitting of nuclear power projects, new technologies, fast tracking a lot of the review processes, and really getting behind this sector when in the past, as I said, it was really in the penalty box. And so it's really sent a strong signal to the market around future demand. Electricity prices are incredibly high right now, and everybody is trying to figure out, how to play this whole value chain. So the price of uranium, as I mentioned, has gone up significantly. The uranium mining companies have been huge beneficiaries because of the demand signals and the price signals. And, I think we have the largest group of uranium funds in the world, which are about $9 billion right now. And it's, as I mentioned, it's been a real big win for our clients.
Tell us a little bit about your uranium ETFs.
Yeah, so the flagship product is the Sprott Physical Uranium Trust. And believe it or not, it gives investors a way to play physical uranium. And you might say, well, how is that possible? Isn't that dangerous? Well, there's a form of uranium called U3O8. And basically, it looks like a yellow powder. And the yellow powder is inert and it is stored in basically like a steel oil drum. And this material in that particular form is basically the feedstock, which eventually gets turned into fabricated fuel bundles many years down the road that goes into a reactor core. But you can basically hold it for many years in these drums. It's totally safe. And we basically have a stockpile of physical uranium that's about 73 million pounds. And just to put that into context, 73 million pounds of uranium held by the trust is equivalent to about 50% of what the world produces out of the ground each year. So it's a pretty large stockpile. And we basically hold this uranium on behalf of our investors in the United States, Canada, and France. These are the three licensed facilities where we're allowed to store it. And it's been a very popular fund. The fund a few years ago was $600 million. It's now grown to almost $6 billion. And, the fund has accumulated enormous amounts of uranium. What was interesting in the last few weeks at the IAEA conference in Vienna, Secretary Wright said that the US should reconsider building a strategic uranium reserve, just like we have a strategic petroleum reserve. If there's a disruption in oil supplies, the government has a stockpile to tap. In the past, the US government has always had large quantities of different critical materials and uranium, whatnot. A lot of those are long since gone, following the end of the Cold War. But there's a key theme going on right now around reshoring of strategic minerals, critical materials for energy security, national security. And uranium could be the next metal that the government says, we want to earmark funds so that we have a greater, supply chain resiliency. So that's something we're looking for. They're doing it with other critical materials, and we wouldn't be surprised if uranium gets added to that list.
Let's talk about copper now, which is also, it is up about 26% this year, and not many people realize, but copper is also an AI boom beneficiary because it is used in data centers, power grids, in addition to electric vehicles and smartphones and many other applications, of course. And lately, there have been many concerns about supply shortages. So tell us what's happening over there.
Yeah, copper obviously is a really important industrial metal. It's a very large market, about $200 billion per year. What's interesting about copper is that it is the backbone of electrification. Anything to do with moving an electron, copper is obviously the solution, whether it's, cabling or, there's so many different applications. China processes about half the world's copper. So we send copper concentrate to China from places like Chile. They basically treat it and refine it and produce copper cathodes, which are like big sheets of copper. And then those big sheets of copper cathode get turned into wires and cables and all these kinds of things. So it's right in the middle of this trade war, given China's, oversized role in the supply chain. But it's also getting a lot of attention because of the push towards electrification. And a lot of that electrification push is obviously being driven by AI data centers, which require huge amounts of electricity relative to conventional data centers. It's other things like obviously electric vehicles and whatnot, but AI data centers is really what's driving, I think, the big push. Now, on the supply side, you think, okay, this is a market that's very large, and we've obviously been mining copper for 5,000 years. So surely we can get a supply response that matches the demand signal. And the opposite's actually happening. We've had a number of top copper mines in the world, and there's been 2 or 3 just in the last 3 months that have had issues at the mines. We've had some floods, some mud issues, And we've had a number of supply disruptions at some of the largest copper mines in the world. So we've gone from, being in a balanced market, I would say 3 months ago, to now we're creeping into a supply deficit because some of these mines are going to be offline for the next, 3 to 12 months. So it is a tight market. There's definitely a shortage of copper concentrate. And I think that's one of the key reasons why the copper price has been really resilient compared to, let's call them, legacy industrial commodities. And I'm going to put things like iron ore in that bucket. I'm even going to put oil in that bucket. So the push around electrification is definitely giving a big boost to copper, and we've had a lot of supply disruptions. If you speak to the major copper miners, they will tell you, yes, the copper price at current levels generates a lot of profitability for them, but to give them the confidence to make, multi-billion-dollar investments to bring new capacity online, they need to see copper prices that are higher from where we currently are. So I think until we see those price signals, the supply response is going to lag. And I think that's why there's been enormous interest in copper, particularly across institutional investors that I think have, connected the dots around copper's role in all of these different themes.
Finally, I also wanted to talk about your critical materials ETF. This focuses on a diverse basket of many other material ETFs that are kind of building blocks of the future economy. So tell us about these materials and why investors should look at this ETF.
Yeah, this is, I think, a product that's really well suited for the current market environment. When we conceived this product a couple years ago, we took a step back to see what was going on in the world. And, I think thankfully we got a bunch of things really right, meaning we saw the world was fracturing in terms of the world order. We saw the strains on supply chains after COVID, and we saw the strategic importance that many supply chains, particularly around critical minerals and metals, were going to have in the world. And in the last few months, what we've seen is a heightened weaponization by China around critical materials and particularly rare earths. And these metals, which most people have never heard of or can't pronounce, play really, really important roles in things like defense technologies, other technologies, mission critical infrastructure, permanent magnets that are used for motors, electric vehicles. So very important. And China controls about 70% of the supply chains related to many of these critical materials. So as you can imagine, China is essentially weaponizing this. They've recently implemented export controls, basically holding back the delivery of these metals to, supply chains in the West as a negotiating tactic as part of this, ongoing trade war that's currently underway with the Trump administration. And I think it's really highlighted the vulnerability that we have if we don't have these critical materials. It affects a lot of important technologies and industries. So what we've done in this ETF is basically create a index that gives you exposure to a number of these materials that we deem to be critically important. So uranium is in there, uranium miners are in there, lithium miners, copper miners, silver miners. We have rare earth producers. So it gives you kind of a nice broad spectrum of a number of different metals that are getting a lot of attention right now. And we're also seeing the US government make equity investments in some of these mining companies that have large deposits of rare earths because they want to create a domestic supply chain. And so we've seen some of the companies in the index have really, really big returns this year as the government has come in, done equity investments, but also done things like create price floors around offtake agreements. So the government saying, we are going to buy your product when it's available, and we're going to pay you a price that's above the current market price. to incentivize you to bring production to market. So we think this is a new theme where governments are becoming much more involved in reshoring the supply chain. You're also seeing another dynamic playing out, and we're calling it, friendshoring, where just in the last week, the US and Australia signed a strategic alliance around critical materials. And this is where I think allied countries are going to work much more closely together to ensure that their supply chains are resilient and that they have basically an alternative to China, which, as I said, completely dominates many of these different supply chains when it comes to critical materials, but also rare earths.
Now, all these commodities have done so well this year. Now, supposing you had to pick one commodity theme and hold it for the next, say, 5 years, based purely on supply and demand fundamentals, which one would it be and why?
Ooh, you're asking me like pick my favorite child. That's a tough one. Okay, I'm going to answer the question with uranium. And I say that because we've been very, very constructive on the fundamentals of this market. And we're saying this for a couple of reasons. One, the world is pivoting back. The world wants to build a lot of new capacity in nuclear. And we have today a structural supply deficit, which means the world, needs about 185 million pounds of uranium this year to operate what we have. We only produce 150 million pounds of uranium. And the amount of uranium we're going to need in the year 2040, based on projections from the World Nuclear Association, could be, depending on different scenarios, somewhere between 3 to 350 million pounds in the year 2040. And we currently produce 150 million pounds. So in terms of a metal that has the greatest mismatch between expected demand and current production, uranium, I think, kind of takes it all. So I'm gonna go with that one in terms of a 5-year forecast.
Excellent stuff. We'll have to leave it there, John. But thank you so much for joining us today, for sharing your insights, and congratulations on all the success.
Yeah, thanks very much. It was great to catch up.
That was John Champalia of Sprott Asset Management. Now let's quickly recap the ETF tickers. So Sprott Gold Miners ETF is SGDM. Their Junior Gold Miners ETF is SGDJ. Their Copper Miners ETF is COPP. And the Junior Copper Miners ETF is COPJ. And the Uranium ETF is URNM. The Junior Uranium Miners ETF is URNJ. And as I had mentioned earlier, they also offer a gold and silver miners ETF. The ticker symbol is GBUG, GBUG. And silver miners and physical silver ETF is SLVR. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.